Tonight I'm going into Penn and Teller mode, demystifying all the overly complicated, technical-sounding Wall Street gibberish that you hear constantly, but might not understand. I want to translate the most overused, underexplained terms in the business, putting them into language that's fit for human consumption. Consider this show your Wall Street to English dictionary, a televised glossary that'll help you navigate your way through tough markets and the tough-sounding terminology that keeps so many people out of stocks. Not doing myself justice. And I got to help you to understand this stuff so you can be better. Of course, joining the club is going to help. Now, again, all this investing terminology sounds difficult because the pros who speak Wall Street gibberish fluently, well, they want it to sound difficult. They're the opposite of me. They want you terrified. They want you feeling totally ignorant and at a complete loss when it comes to managing your own money. My mission is just the opposite of theirs. I am here to try to enlighten you, to teach, because I know that you can do better for yourself than the professionals. I've been down here for 40 years on Wall Street. I know this stuff. And most of the professionals, they kind of just want your fees. I'm not managing anyone else's money, and I don't own stocks except for my charitable trust, so I give away my winnings to charity. And I walk you through the whole process of running the trust for the CNBC Investing Club. It's the establishment. It's not just enough to come out here and tell you which stocks I like, because you can't own them if you can't understand them. Knowing what you own is a must. It's one of my cardinal rules. It says if you don't have a good grasp of what you own and what your holdings are, you won't have any idea what to do when the stocks turn against you. And believe me, inevitably, at some point, they will. You can't know when to hold them and know when to fold them, in the immortal words of stock sage Kenny Rogers, unless you know what the heck it is that you're actually holding and what might make you fold. Unfortunately, the profusion of arcane terminology on Wall Street makes it much harder to know what you own. So let's continue our vocabulary lesson with another ultra-important piece of verbiage that's hardly ever explained to you, even though it's used constantly. Risk-reward. The risk-reward analysis pretty much defines short-term stock picking. So what does it mean? All right, let's break it down into its component parts. Assessing risk is all about figuring out the downside, how much you potentially stand to lose in a given stock, how far it can conceivably fall in the near term. Assessing the reward, on the other hand, means figuring out the potential upside, how much the stock could rally if everything goes right. Too many investors only focus on the potential upside when they're analyzing stocks, and that is a great, great mistake. It's much more important for you to understand the risk side of the equation, because the pain from a big loss hurts a lot more than the pleasure from an equivalent size gain. Trust me. But how exactly do we figure out the risk reward? Okay, these are determined by two different cohorts of investors. The reward, the upside, is defined by how much growth-oriented money managers could be willing to pay for a stock. They create the top. The risk, the downside, is created by what value-oriented money managers do. What value-oriented money managers would pay on the way down. They create the bottom. To figure out the risk, you need to consider where the value guys will start buying on the way down. To solve for the reward, you need to think about where even the most bullish of growth guys would start selling on the way up. When asked, I usually boil the risk reward down to something quick and dirty, like 5 up, 3 down. But how do I get there? How do you know where growth money managers will start selling and value guys will start buying? Okay, for that, you need some insight into how they think, and that requires translating another piece of esoteric Wall Street lingo. It's called growth at a reasonable price. I really believe this, by the way. Growth at a reasonable price, a.k.a. GARP. When we talk about growth at a reasonable price, that's not subjective. It's a method of analyzing stocks first popularized by the legendary Peter Lynch by comparing a stock's growth rate to its price-to-earnings multiple. If you want to figure out the maximum the growth guys would be willing to pay for a stock, you need to be able to look at the world according to GARP. You want to learn more from Peter Lynch? It's easy. Go to Amazon and buy One Up on Wall Street or Beat the Street. These are two of the most important investing books ever written. Now, here's a quick and dirty rule of thumb that's hardly ever let me down, although there are some exceptions, a rule that can really help us figure out when a stock might be overvalued or undervalued based on what the growth and value managers would be willing to pay. If a stock has a price-earnings multiple that's lower than its growth rate, then that stock's probably cheap. And any stock selling at a multiple that's more than twice the size of its growth rate, probably too expensive. So if a stock's trading at 20 times the earnings and it has a growth rate of 10%, then it probably doesn't have much more upside. It's reached the 2 times growth ceiling. Always remember that. Here's another piece of Wall Street gibberish that can help simplify the process. The PEG ratio, PEG, that's the price to earnings to growth rate, or the PE multiple divided by a stock's long-term growth rate. A PEG of 1 or less is extremely cheap. and 2 or higher is prohibitively expensive. Sell, sell, sell. A high-octane, super-fast grower could sell for 40 times earnings and still be inexpensive because if it has a 40% plus long-term growth rate, giving it a PEG of just 1 right at the cheap end of the spectrum, and the growth kept accelerating, sending the stock to a new high after new high. That makes sense to me. Where did I come up with these numbers? Observation. The value investors who will be attracted to stocks selling at pegs of 1 or less create a floor. You'll usually be able to find a buyer if the stock's multiple is at or below its growth rate. The growth investors who be buying high multiple stocks hardly ever pay more than twice the growth rate, a PEG of 2, which means there's almost no way that stocks go higher. So stick with the example of Google back when it still held that mega growth mojo. With a 30% long-term growth rate, it would have become a sell if it traded to 60 times earnings. Just too darn high, as I have learned over and over and over again since the show began so many years ago. Like with any of my methods, or anyone else for that matter, this one is rough approximation, a bit of subjectivity. It's useful, especially when you're trying to figure out the risk-reward, but it's not always right. And it only applies to companies that trade on earnings, not unprofitable companies with stocks that trade on sales. Plus, stocks will often get cheap on an earnings basis simply because the estimates are too high. You see this all the time going into a slowdown. In those cases, the stock could trade well below the 1x growth floor. Its PEG could just keep sinking and sinking. And the fact that it looks cheap, it's a value trap. It's not a buy signal. On the other hand, the best time to buy cyclical stocks, think the smokestack industrial types, is when their multiples look outrageously expensive because the earnings estimates are way too low and need to be raised to catch up with reality. That happens when the economy is bottoming and about to rebound. The bottom line, know what you own and know what others will pay for it. That means you need to understand the risk reward, the potential downside and potential upside before you purchase anything by figuring out where the growth investors put in the ceiling and where the value investors create the floor. Nicholas in Nevada. Nicholas.
Hey, how's it going, Mr. Cramer? This is Nick Michelle from Las Vegas, Nevada. I'm a college freshman out here in California trying to start my own investment management company. I was just looking for some quick advice and kind of personal, advice on how to run that from a freshman's perspective.
Well, I'll tell you, you're young, and that means you have to go with higher risk stocks than I typically talk about on the show. Maybe some smaller cap stocks, maybe some biotechs, maybe some companies that are on the ground floor of AI. I don't want you to be loaded up with companies that are older because you have your whole life to make it back if they go away. A lot of our older viewers and middle-aged viewers cannot afford that to happen. So go with high risk, potentially high reward stocks. Mark in Iowa. Mark.
Hi, Jim. I'm a happy club member, and thank you for taking my call.
Thank you for being a member of the club. It's terrific. How can I help?
Well, Jim, I have a real estate question for you.
Okay.
Higher interest rates make it more difficult for families to afford a new mortgage. What effect will this have on REITs containing single and multifamily units?
Well, I think they're going to be under pressure. And I think it's natural that you ask that question. And it's one of the reasons why I'm not recommending any of those stocks, because you correctly have thought about what is the nemesis of those particular stocks. Now, as long as you understand the risk reward, the GARP and the PEG ratio associated with picking stocks, you're much better prepared to know what you own and know what others, more importantly, will pay for. Now, much more Mad Money. Do you know the difference between a rotation and a correction? I'm not done cracking the Wall Street code. And you better be seated when Professor Cramer opens the dictionary. Plus, my colleague Jeff Marks and I are taking all of your burning investing questions, so stay with Cramer.
Coming up, what big investment lesson can you learn from a bottle of milk? Cramer's working till the cows come home. Keep it here. Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.